It's going to speak to things like resilience, Teflon, tranquility, even in spite of what has seemingly been an unending news cycle around the so-called Freedom Day that inaugurated just a whole worldwide stream of tariffs. But when you look at the marketplace, it's been truly quite impressive how it has dealt with all of this news economically, certainly politically. One way to measure that is to look at the MOVE index, which is the VIX version for the bond market. And that speaks to bond market volatility. And as of today, and certainly as of the end of the third quarter, the MOVE index has retraced all of the volatility that began when the Fed started raising short-term interest rates in March of 2022. So in that sense, the bond market is pretty unconcerned, at least from a volatility standpoint, and it seems to have been. In the credit markets, it's similar. We've had the investment grade bond index begin the year in the low 80s sort of basis point spread to the particular benchmark broadly. That's the broad investment grade index. Moved meaningfully higher in April, but to retrace all the way back to mid 80s at the end of June, and in the third quarter at a multi-decade low in the mid upper 70s. High yields had a lot more volatility. It began the year below 300, again, not a really wide spread to benchmarks, at least in relationship to history. And we presented graphs historically, and we will probably again in the third quarter update. Spiked particularly meaningfully in that April time period, but retraced rapidly to almost where it began the year at the end of June to just under 300, 296, and is even lower as we speak. As at the end of September, it was 280, so at the low point for the year. And even when you look across the economic data points, which we don't have a lot right now because the government is shut down, but we do get things like the Beige Book, which is produced 8 times a year, and we just received the October report that spoke to kind of that almost tranquil, resilient sort of economy through all this news that we've experienced in the past 9 months, which was a slowing to little changed economy, despite even some pockets of growth and varied regional impacts around inflation impacts. So overall, the macro environment still seems to be quite solid, reasonably so. Of course, these sort of things can change almost at a moment's notice with the next sort of shock that might impact the economy and the market broadly. But overall, that's kind of where we are from a market perspective. And I'm going to turn it over to Nolan.
The news cycle seems to be focused a lot on the pace of job growth slowing, which is true. But the unemployment rate, which feeds into that, is also very low. The most current reading we don't have the September reading because, as Tom mentioned, the government is shut down. But as of August, the unemployment rate is 4.3%. The long-term average going back to the 1940s is 5.7%. 4.3% actually represents levels below some previous trough levels of employment before a recession has started. In the 2007-2008 GFC, the unemployment rate troughed, so its low point was actually above where we are today. So from a historical standpoint, the job market and the unemployment rate remain strong. However, those are actually considered lagging indicators. If you think about job numbers, companies make hiring and firing decisions after economic data has impacted their business. What do they do before that? Is they would maybe lower hours, they might freeze hiring altogether, they might cut bonuses, but truly impacting your labor force, making those core hiring, firing decisions, those typically only happen after the data has actually turned. What would be considered a leading indicator would be like the weekly initial jobless claims. That is a measurement of people seeking unemployment for the first time after a job loss. And it's a weekly data set. So think of it as a real-time, almost real-time indicator of either labor market stress or resilience. And on that front, again, going to the data that we have most recently in September, because we haven't gotten an October reading because of the government shutdown, those numbers are bobbing along all-time lows around 200,000. I think the latest reading was 215,000. Again, going back to the data set of coming from the 1960s, we're bobbing around, like I said, almost all-time low level. So that's where we would think of, if that were to inflect higher, that would be a leading indicator of coming stress, which would then feed through into the unemployment rate in the jobs numbers. So for now, as Tom mentioned, the economy, despite the tariff noise and uncertainty, the economy just seems to be moving along. And although the job growth has slowed, the leading edge of it is not showing stress at all.